Andrew Stotz of A.Stotz Investment Research, and I'm talking about the top 9 valuation mistakes and how to avoid them. This is mistake number 8, choosing an unreasonable cost of equity. The top 9 valuation mistakes that I've seen in my career over the last 25 years as an analyst and as a head of research, as well as in the Valuation Masterclass, come down to this. Number 1, overly optimistic revenue forecast. Number 2, underestimating expenses causing unrealistic profit. Number 3, growing fixed assets slower than revenue. Number 4, confusing growth Capex with maintenance Capex. Number 5, forecasting drastic changes in the cash conversion cycle. Number 6, underestimating working capital investment. Number 7, valuing a stock using the calculated beta. Number 8, choosing an unreasonable cost of equity. And number 9, not properly fading return on invested capital. And this is number 8, choosing an unreasonable cost of equity. So let's take a look at this. First, a very common mistake that I've seen made by analysts is discounting the future cash flows at an unreasonable cost of equity. Analysts are notorious for trying to manipulate their cost of equity to get the outcome in valuation that they want. As a head of research, my focus was to prevent them from making these types of errors by giving them some framework to think in. Now, why is this important? Well, that discount rate can massively impact the final valuation, and even if forecasts are perfect, it would cause a wrong estimate of value. So, a firm's cost of equity represents the compensation that the market demands in exchange for bearing the risks of owning that stock. Remember, it's the market that is setting the cost of equity, not you. Now, of course, as an analyst or as a stock picker, we think we know the right cost of equity, and therefore we're going to set it ourselves based upon what we think. And theoretically, we're going to think that the market is wrong. Well, you need to think carefully and have a good structure and framework if you're going to do that. If your assumption of cost of equity is too high, you'll underestimate the value of the company. And if it's too low, then your estimate of the value of the company will be just too high. So, analysts can often get lost in the determination of the various components of cost of equity and miss the big picture. There's the risk-free rate, there's the market return, and therefore the market premium, there's the beta. These ways are ways of slicing a pie, but that doesn't change the size of the pie. So what cost of equity do you use, and how do you get it? Well, I did a simple study here where I wanted to help determine what's a reasonable cost of equity in both emerging and developed markets. I studied the risk-free rate, the beta, and the market risk premium of these markets over the recent years to come up with a range for cost of equity. Now, I have a much more detailed study, but I'm going to keep it simple in this one. The risk-free rate was based on the 10-year government bond yield in each country, and the market risk premium was calculated based on the Gordon growth model using the implied equity risk premium. And here's the end result of what I got. I've grouped developed markets and emerging markets, and what you can see is based upon the findings, a reasonable range of cost of equity is about 8 to 13%. We can see developed markets at a beta of 0.75 is 8 and at 1.25 is 12. And we can see for the emerging markets, a beta of 0.75 gives us 9.5 and 12.5 for a beta of 1.25. Now, you've already heard from my prior discussion about why I choose beta of 0.75, 1, and 1.5. But here we can see, forget about all of that and just look at a range between 8 and 13%. We can see that emerging markets' cost of equity was slightly higher than developed markets due to the higher risk that investors are bearing. So, to keep it simple, know that majority of the outcomes are going to be between the range of 8 and 13%. Why are you outside of that range? Really? How sure are you? Well, no problem. If you want to go outside of the beta or the cost of equity range, do it. But just know that you need to explain it in more detail why you are choosing that high, very high, or very low cost of equity. And if you've done that, then you've really done your job as a stock picker or as a valuation expert. You are showing your significant point of difference and why it's different. But most of people that I work with make the mistake of they have a too low or too high cost of equity and they never explain why. which leads me to believe it's just a mistake. So, what have you learned? Well, you've learned don't get lost in the components of the cost of equity, focus on the end result. Also, too high or too low cost of equity can significantly change your estimate of a firm's fair value. And based upon our study, we consider a cost of equity ranging from 8 to 13% to be a good rule of thumb. So there you have it. That's the number 8. Now let's move on. I'll see you in the next video. Not number 9. The final one is not properly fading return on invested capital. I'll see you there.